Alright, hi guys. So the bear market is finally here. The last bear market was actually just a year ago in December 2018. It just lasted for 3 months. And of course, the big one before that was 10 years ago during the financial crisis of '08 to '09. So here we are again with another bear market. Now, bear market by itself is not surprising, right? It's part of the game, it's part of the market cycle. And a bear market is defined as the stock market dropping more than 20% from its highest point. So what is surprising is the speed of the drop this time. See, usually it takes months for the market to drop over 20%, and the market tends to go down in kind of like these wave patterns going up and down. But in this instance, because of the 1-2 punch from the coronavirus, the oil price crashing, this massive uncertainty, the market's down from the peak 27% in just 2 weeks. And it has literally fallen in one straight line. Now, many professional investors have never seen this before, me included. So you can imagine that this is freaking a lot of people out, especially inexperienced investors, virgin investors who just got into the market and they're going like, what the heck is going on? They're freaking out. So this video is created to really help you to understand how can you not only survive and protect your investments during this bear market, but how do you build your fortune in the time to come with this bear market? So like I said, bear markets are part of the game. They're part of the market cycle. Now, I've been investing for about 27 years, since I was about 19 years old. Yeah, I know I started late. Warren Buffett started at 11. Darn it, but it's fine, right? So over the course of my career, I started in about 1993. I've seen 6 bear markets in my investment career, excluding this one right now. So I've seen the crash of 98, 2000, 2007 financial crisis, 2011, and again, like I said, a year ago, 2018. Now, not only did my investment portfolios survive those bear markets, but in fact, my wealth multiplied many fold following every single bear market. So looking back, I can tell you bear markets were the best things that happened to my investments because they allowed me the opportunity to buy my favorite stocks at massive, crazy discounts. And they later made a few 100% returns when the bull market came again. And I can tell you that this bear market is no different. I'm 100% sure that I'm going to leave this bear market a lot wealthier than when I came into it. And sadly, the same thing's not going to happen for every retail investor because it depends on the decisions and actions you take during the bear market. Whether you decide to sell in fear and panic and put all your cash under your mattress, or whether you decide to learn how to protect your portfolio and you decide on how to pick great quality companies and massive discounts. This decision is going to determine how you leave this bear market. Do you leave it a lot wealthier and richer, or do you leave it a lot poorer? So it's my sincere hope that in this video, I'm going to leave you with the principles and the strategies that will allow you to be one of the few retail investors that's going to leave this bear market wealthier than ever before. So first, let's take a step back and really understand about the stock market cycle of bulls and bears. It's kind of like the weather, right? Summer and winter. It's a cycle, it comes and goes. So the first thing you got to understand is that in the long run, the stock market, the index, always goes up since it started in 1792, 227 years ago. So what you're seeing right here is the Dow Jones Industrials Average, or the Dow Jones Index. Now, I don't have the 200-year chart, so this is the 119-year chart since 1900 to now, okay? So you can see that, again, in the long run, the market always goes up. And I can tell you that 10 years from now, 20 years from now, the market's going to be a lot higher than it is today. And this is despite crisis and uncertainties in the market. I mean, look at the last 100 years. We had World War I in 1917. We had the Great Depression in 1929. We had World War II in the 1940s. We had the oil crisis. We had Black Monday. We had the Asian financial crisis. We had the dot-com crash. We had the US financial crisis. We had the European debt crisis. We had the trade war. All right. So people are afraid to invest because they say there's so much uncertainty. There's the oil crash, the trade war, there's the oil price crash. Hey, there's always been problems. There's always been some uncertainties. But despite that, the market always goes up. And in fact, it's during these times of uncertainties, we're able to enter the market at the lowest prices. So, although the market always goes up in the long run, but we know that in the short to medium term, it's like a roller coaster. All right, it goes through ups and downs, and we call them market cycles. So you have got, within that period, you've got bull market cycles. So bull markets, think of it as summer, right? Having fun, optimism. In a bull market, what you see, right? Prices make higher highs and higher lows. And that happens when the economy is expanding, when there's a lot of confidence and optimism, okay? Now, we know that summer doesn't last forever. You gotta have winter. Winter will come eventually. So in a market, winter are bear markets, okay? And bear markets come every couple of years. And in a bear market, what happens? Prices go up and down as well, but it tends to make lower highs and lower lows. And people are fearful, they're pessimistic, the economy is contracting. Now, if you take a look at this great summary chart by First Trust, that's a source, you can see something really interesting. If you take a look at all the bull and bear markets, over here, you can see that these ones in red are the bear markets, okay? And the ones in blue are the bull markets. Now, if you add up all the bull markets, for example, this bull market lasted 9.3 years, 5 years, 12.8 years, 12.9 years, and so on and so forth, you'll see that throughout the market's history, 64 years, we were in bull markets, right? And if you add up the bear market periods, right? 6 months, 1.6 years, 1.8 years, 3 months, 2 years, 1.3 years. It makes up a total of 11.1 years, which means historically, the market is in summer 85% of the time. And it's only 15% of the time which we're in winter, we're in a bear market. Now, the other important fact is that stock prices rise in a bull market a lot more than they fall in a bear market. Now, bear markets may seem scary because the prices are going down 10, 20, 30%, right? For example, look at this one, right? So the market went down like 21%. It seems scary at the time if you focus into it. But what the heck is 21%? When it went up 935% in the next bull market. Same thing with the next bear market, right? Went up 22%, people are freaking out, but what the heck's 22%? It then went up 143%, right? It's down 29%, it went up 75%. It dropped 42%, but went up 845%. And over here, it dropped 29%, up 816%. Down 44%, up 100%, down 50%. Seems scary like shit, but it's up 350%. In fact, this up to 2018. If you put it to 2019, it's up another, 40, 50%. So can you imagine how much money you would make if you bought the right companies during those bear markets, when you were going down 20, 30%, you added shares of your favorite companies, of the best companies, and you did it before the bull market started. Once the bull market comes, that's how you build your next fortune. Now, not only that, but on any given year that you put your money in the stock market, there's a 74% probability the year will end with a gain. All right, take a look at this chart. This is from 1951 to 2019. And you can see that out of all those years, 69 years, you can see that 51 years ended with a gain from January to December, and 18 years ended with a loss. So that means that, again, at any time when you enter the market at the beginning of the year, 74% of the time is going to end up higher by the end of the year. Those are pretty good odds. So to psychologically survive a bear market, you got to understand what to expect during a bear market so you don't freak out, all right? So since 1929, there's been about 21 bear markets. And again, the last one previously was 2018. So bear markets vary in length. Some of them can be as short as just 3 months. Some of them could be 31 months, which is about, just over 2 years, okay? Now, if you average it out, the average bear market lasts 17 months with a recession. So if there's a recession that comes with it, 17 months, and that's slightly over a year. Without a recession, it's over in an average of 12 months, which is 1 year. So okay, right? So during a bear market, prices are falling from the peak all the way down. And again, bear markets, technically speaking, means it has to drop at least 20% from the peak. So bear markets would be anywhere from a 20% drop to as big as 50% during major crisis, or even 54%. So the average drop in a bear market without a recession is 29%. And we're done. Okay, with a recession, 42%. If you average it out, the average bear market prices will drop 36%. Okay, so once you know these numbers, you can know what to expect and you can roughly guess when we are near the bottom. So now we know what to expect during the bear market. Let's take a look at this current market right now. Where are we and how much further can we drop? Okay, so this is the S&P 500 and I'm looking at daily candles right now. You can see again in the last 2 weeks we had a really sharp 90-degree drop all the way down. And so far from the top, we actually went all the way down 27%. Again, this has been the fastest drop in history. Now, is this good or bad? To me, this is good news because the faster the market drops, the faster it tends to rebound. It's kind of like a rubber ball, right? The faster you throw the ball down, the stronger you throw the ball down, the faster it's going to rebound back up again. And the other thing to understand is that this, unlike past crashes, this is not a financial crisis. This is a health crisis. Very, very different, right? So, like China was in the worst situation with this, right? Started with China, but in 3 months, now China's cases are dropping. They're going back to normal because they shut down the whole city. Okay, so I believe that if Europe and the US can get their act together where they shut down the city and everyone stays at home, in 1 to 2 months, this entire thing will be resolved and markets will rebound to all-time highs. So I believe that this bear market will recover really, really fast. That's the good news about it. The next question is, how deep can it drop? Well, let's take a look at certain levels, right? So what I'm going to do is I'm going to kind of like zoom out, look at the weekly candles. And over here, you can see I've kind of like put in these levels. So this red level represents 20% drop from the high, okay? This level would be 30%, and this level would be 40%. So again, why do I put in these levels? So I can see where we could potentially drop to during this bear market. So like I said, this current market, we actually went down to 26% over here. But we had a strong rebound back to the 20% mark. All right. So currently we're here. We're at about 2714 on the S&P 500. Now, so what's the lowest you can get? So again, based on history, we saw that the average bear market with a recession is about 42%. Now, I've got no idea if we're going to go into a recession, but let's assume if we go into a recession, then the potential downside would be about the 40% mark, which means market could drop to 2035. Okay, so this, I would call it the biggest drop I would expect from this bear market. Of course, it could go lower, you never know, but I would say that if it reaches minus 40%, I can kind of guess we are near the bottom, okay? But again, if a recession doesn't come, the average drop would be about 29%, or let's give it 30%, which is over here. That's the 30% mark. And this coincides with the previous low made in December 2018. So that would be 2375. All right, so there you are. So again, we are currently at 2714. Okay, and if we continue going down, the downside I see will be 2375 and 2035. Now, nobody knows where the market is going to bottom. Not Warren Buffett, not Ray Dalio, not Adam Khoo. And you can't always be lucky enough to pick the exact bottom. And that's why as investors, when we buy shares of our best companies, we buy them in stages. We dollar cost average in our positions. We never buy at one time. So the moment it hits a level, we start to add some shares. So for example, over here, you can see it's kind of like bouncing off the 200 moving average. All right, you can see there's a strong support here. So you never know, right? The market can do anything. We could actually, this could be the bottom right now. This could be the bottom, and we could actually rebound all the way back to the high. You never know, right? So at this level, I'm beginning to add some shares. But here's the thing. If it drops to the 30% level, I'm going to add more shares. If it drops to the 40% level, I know we are near the bottom, I'm going to add even more shares. We call this dollar cost averaging. Now, is it good to average down shares? It depends. If you are buying quality companies that you know will rise over time, the lower it goes, the better deal you're getting. But you never do this when you're trading speculative companies. When you trade speculative companies which are overvalued, that do not have a strong competitive position, you never, ever average down. The moment you enter, it hits the stop loss, you get out. Now that's for trading, it's different. This is investing in good companies like Microsoft, Amazon, Apple, Johnson & Johnson. These are companies that are undervalued, they have strong cash flows, they will go higher once the rebound happens. So these are the ones that I dare to buy even more as they go down at these support levels. Now, many investors have this fear that what if I buy now, I buy at 40%, it drops to 50%, what if that happens? Who the heck cares if you look at the big picture, right? Remember this chart. Let's go back. Remember this chart, okay? And if you look at the big picture, right, look at, for example, this last crisis over here. This was a financial crisis, right? So, for example, imagine if it dropped 20% over here and you started buying at 20%. And after you bought, it dropped another 20%. You say, oh my God, it dropped another 20%. But who the heck cares? Whether you bought at minus 20% or minus 40%, it doesn't matter. Why? Because following the bear market, the bull market went up 350%. Sorry, if you add in 2019, it went up about almost 400%. So again, when you look at the big picture, it really doesn't matter whether you went in at minus 20, minus 30, or minus 40. You're going to make a lot of money if you bought the right companies and you held on. Now, even if the market does drop to 30%, 40%, not all stocks will drop that amount at the same time because it depends on the kind of stocks that you have in your portfolio. Because not all stocks are the same. See, when you buy a stock, you're buying a business, and businesses are all different. So broadly speaking, I divide my portfolio into three kinds of businesses or stocks. First, we have got defensive companies. So we call this recession-proof stocks. These are stocks that sell a product or service that you have to use even during a recession. For example, you got to use detergent, you got to use toothpaste, you got to use hair gel, you got to use toiletries. These are defensive companies. You got to use healthcare, right? So defensive companies are companies like Procter & Gamble, Johnson & Johnson, Unilever, Clorox, Colgate. These are defensive, kind of recession-proof. And then you've got cyclical companies. Cyclical companies are companies whose products and services depend on how well the economy is doing. So for example, auto manufacturers, banks, real estate. All right. So for example, during good times, you may buy a brand new car. In good times, you may, go buy a home. You may take more bank loans. But during recessions, you cut down on your expenditures on luxury goods, luxury products. You take less loans. So cyclical stocks like oil and gas, like banking, like real estate, right? They go up really fast in the economic expansion, but during a recession, they drop even faster. And then you've got secular growth stocks. So secular growth stocks are stocks that will always grow regardless of whether there's a recession or not, right? So for example, what are the secular growth stocks? You have got Facebook, you have Amazon, you've got Microsoft, you've got Adobe. Because again, in times of recession, people still got to use Microsoft software. People still going to order things online from Amazon. People are still using Facebook. They're still searching with Google. They're still watching YouTube videos. So these are secular growth stocks. And that's why it's really important that your portfolio, you don't have too many stocks that are cyclical. If you have got too many cyclical stocks, you find that the stocks will drop really fast in your entire portfolio. But if your portfolio has got defensive companies, a bit of cyclical, a lot of secular growth stocks, it's cushioned from the bear market. Because as the market comes down, many of the defensive companies will not go down that much. In fact, they may even go up at times. Again, like McDonald's or P&G, right? Secular growth stocks will still grow even during a protracted recession. So for example, during the last bear market in 2018, you can see the S&P 500, which is the 500 biggest companies that have a mix of defensive and cyclical companies and crap companies, right? The S&P 500 went down 20% during that bear market in 3 months. But McDonald's did not go down. During that same period, McDonald's went up during the bear market. Why? Because during a financial crisis, people still eat at McDonald's, right? In a recession, you still go to McDonald's. So McDonald's is a very defensive stock. Same thing. As the market went down, Procter & Gamble, P&G, the stock price went up because people still use their shampoos, their soaps, their personal care products even during a financial crisis. But companies like Caterpillar, where they involve in construction and industrial goods, what happens? That's right, these are cyclical stocks. When a market goes down 20%, they go down 20% as well. So now let me answer the most common questions people have been asking me about what to do in a bear market. Question number 1, should I sell my stocks in a bear market?